Rate cuts and recession. That's what today's video is about. I'm going to describe 3 scenarios that are going to dictate how the market responds to what the Fed does in September. Now, we know because he said so at the Jackson Hole conference that he was going to give the first rate cut. And I'm going to go through some scenarios about how the market typically responds to the first rate cut. But it's not getting a rate cut that really causes the markets to crash. That's not exactly why the markets crash. It's how the markets interpret why the Fed cut. Because there is a scenario that if the market interprets that the Fed has nailed it, the proverbial Goldilocks environment, the proverbial soft landing. It's actually referred to as the normalization of the market because we get good data. What good data are we looking for? Well, we're looking for unemployment to stay low and we're looking for inflation to come down. That's the Goldilocks environment that could actually cause the markets to go into an extremely strong rally with a very minimal amount of choppy or volatile days. That's the best case scenario to this upcoming Fed cut. Now, that's an elusive scenario. The market really, I can't remember ever getting one of those, but I'm going to take you through some scenarios where the Fed cut and how the market reacted to those cuts to give you some fresh perspective on what might happen in the next 30 days. And I think you're going to find that very interesting. And then I'm going to go over a couple hot plays that you need to be watching. The markets started off this morning absolutely gray pre-market. There was no green stocks to be tracking this morning. And after the markets opened, big tech sold off. But I'm going to take you into a couple big tech charts. And you're going to see right away that even though it felt bearish today, the markets are absolutely still in a bullish stance as we move closer to this September rate cut. And I want to remind you guys, the markets go up before we get that rate cut, and the likelihood is that we are going to continue to go higher. I'm bullish and in a buying mode right now, and I know that goes against the trend and it goes against the way people are feeling, but the data and the charts are driving me, and we're going to go through some data and we're going to go through some charts today. This is the Stocks with Josh show. Thank you for joining me. Thank you for just saying hi and dropping a heart in the comment. I love you guys. I appreciate each and every one of you. And the feedback that I get on this show is deeply appreciated. Hit the like and the subscribe to keep getting these types of videos, commentary on stock and crypto. I'm giving you guys my overview of the markets, but I'm also giving you guys my plays and what I have conviction about. It's not a suggestion for what you should buy, sell, or hold. It's simply what I'm doing with my money. And I need to warn you that there are always scammers who use my face and my name. They try to get you to send them money. They'll promise that they will invest it for you while acting like me. It's not me. I won't do that for you, but you can join the Stocks with Josh Discord. It's the Chart Goat University where you can learn to chart. You can trade alongside me and other crowned traders. We've got some really great guys in there trading the SPY daily, as well as some long-term investments, some share swing trades, and some crypto trades. We've got it all in there. And education, where we're slowly decoding and demystifying the charts, because really it's not as scary as you think. You just need to be taught. You just need to put a little bit of effort in, and once you do, it can change your life forever, knowing how to get in at the right time, how to take profit. This is a learnable skill set, and I'm laying those videos out each and every week. We're doing micro classes. Okay, guys, let's talk about the last times the Fed cut rates and what happened immediately after, okay? So the first time I'm going to cover is a data point from July 20th, 1989, back in the day. And after the Fed gave a cut at that time, the market rallied for nearly a month. Specifically 25 days, the market went up 5.26%. Quite a reaction to a Fed rate cut. Not what everyone's expecting is a market that absolutely goes on fire. Now, after that, the reason why the Fed cut and the next couple data reports kind of confirms whether the Fed was ahead or behind schedule. And that's how it works. So initially, the market might give the Fed the benefit of the doubt that he is landing the plane softly. And so they're going to say, hey, great job. We needed that cut and you gave it to us. But then the data comes out and it either shows freakishly high unemployment and maybe even runaway inflation, and everybody panics and says, you screwed us all over, you've done a terrible job, Jay Powell, and they sell, sell, sell. In the case of 1989, the markets dropped 20% in the next 285 days after that initial 1-month rally. So at the point that began to get more data, the markets began to sell off, but it wasn't a very deep sell-off. It was just 20%. And even though that can be scary when you're in the middle of it, it really, for the most part, for a long-term investor, it opens up a great opportunity. But most people, when it comes down to 20%, think it's going to go to 30, 40, and 50, and they still don't invest because they don't have an investment plan. That's not going to be you guys, though. It's not going to be me. All right, let's talk about the next scenario where he cut rates, and that was in 1990, July 13th. Now, this scenario, the markets went up again. So 2 times here, the Fed's cut rates. The markets went up only 1.24% over the next 2 days, and then there was a 20% pullback. But this time, it didn't take 285 days. This time, the pullback occurred in 88 days, so less than 3 months. And so this is a scenario where there was a little bit more of a panic. And the market initially, based on some of the initial data reports, thought the Fed had got it wrong, but then realized that the data was pretty darn good. Now, personally, this is closer to the scenario that I think we're in, where we do go back 20% over a shorter amount of time, not a multi-year pullback with a deeper pullback. But we'll get to that more at the end. The next one we're going to analyze is the dot-com bubble of 2001. And January 1st, the Fed comes out and says, guys, we need to create some monetary easing here. And he creates a cut, and the markets loved it. It was the dot-com era, kind of similar to now, where innovation was a frenzy on Wall Street. The online, internet, website business was going to change the world, which it did. And so as soon as the market was given a rate cut, everybody thought it was going to be back to business, building online empires. And the market went up 8.15% in 30 days. That's an incredible up move, nearly 10% in the next 30 days. But that actually isn't what stuck around. Once the market began to realize that the websites were not going to create revenue as soon as they hoped, then the market actually crashed 40%, 39.9, almost on the penny of 40%, 39.9, and it took nearly a year and 3/4 of a year, almost 2 years for the market to pull back that 40%. That was a very deep recession because there was a big bubble at the time it was the internet bubble. Now, some would say that we've got a big artificial intelligence bubble, but I don't believe that. I'm just going to tell you right now, I think artificial intelligence is the real deal, and I think that we've barely scratched the surface, and I believe that it's going to get employed much quicker than the internet did because we have the internet foundation. At the time, we were pretty green. People didn't even have personal computers back then. Now everybody has 2 or 3. They've got iPhones, iPads, and laptops at home and at work. Back in 2001, that wasn't the case. And so I think because the foundation is laid, I think that we're not going to have as deep of a recession as we did back then. And some people are making an illogical comparison that I don't think is correct. So the next one is 2007 rate cut. Now, this was a doozy because you guys know that after this, we had the Great Recession, which was a monumental pullback. But yet again, as soon as the Fed gave the cut, September 18th of 2007, the markets loved it. And for 23 days, yet again, nearly a month, for 23 days, it went on a rally going up 6.56%. Guys, and after that, of course, we know the Great Recession went down 54%. The S&P was half off, baby. And that lasted for 538 days. And I remember living each and every one of those days and watching my long-term portfolio just go down and went to 20%, then 30%, then 40%, and then 50%. And I remember thinking, wow, is Wall Street broken? But it wasn't. We're way above those those lows today. It was just another opportunity to buy, invest, realign your portfolio to leading companies that could have made you a millionaire between 2007 and today off of small amounts of money invested on Wall Street. Don't let anybody take you away from this journey, guys. And I lived through that 2007, 2008, 2009 scary time. And if I could go back and have more confidence to invest more, I would. So the last one we're going to analyze is the one we just recently got, and that was the COVID response of March 3rd, 2020. The Fed gave a cut, and we got a one-day rally up 1%. And then in the next 20 days, okay, so less than 3 weeks, the market crashed 30%. And again, it was another great recovery moment. And so what did we just learn? Well, hopefully, if you're able to follow all that data that I unwound for you, the majority of the time when the Fed gives a rate cut, the markets rally and they go up hard, between 5 to nearly 10%, typically within a month, right? And so we get this rate cut here in September. We still have time between now and that rate cut for the markets to go higher or just to go sideways and be choppy. But the bottom line is, I still think that right now there is an opportunity for risk positions, especially going all the way up to the cut and after the cut. I think that it's all going to come down to the market's perception of the data after the cut. And that's the story that we're going to be talking about today. So I'm going to outline these three scenarios very quickly. The first is a panic cut. Now, we got a panic cut when COVID hit the markets. The Fed had to do an immediate response to monetary policy and create some easing because of the fear of the impact of COVID on business. That was a panic cut. Now, panic cuts have the quickest recovery. They don't last very long, and they don't go very deep, and they're not very bad. They typically recover in 1 to 3 months, and that's exactly what we saw with the COVID scenario. Now, the next one is a recession cut. Now, this one's truly driven on bad data. It means the data's gotten away from the Fed, and he's having to respond to the data. He's not in front of it, he's behind it, and he's trying to catch up because the markets are punishing everybody. Unemployment's spiking, manufacturing PMIs crashing, and he's having to get liquidity moving again to save American jobs and American profitability, right? And so that's a recession reason. Now, the markets aren't really believing that that's the situation the Fed is in right now. Why? Because Q2 earnings on the S&P 500 were actually pretty darn good. So the market is not desperately in fear of bad data, but they're very sensitive to the idea that we could begin to fall into that downward spiral. And so the market's going to believe that the Fed is producing the perfect soft landing Goldilocks environment when he gives that first cut, that he's actually doing it ahead of bad data, that the data is under control, markets can rally. That's where I think we're at. Now, what happens is if in the coming months, September and October and November, the data starts to look really ugly, then everyone's going to panic and they're going to sell. The last scenario is that normalization cut. And now this is the one that the market is hoping that we're in right now. It's the Goldilocks cut. It's Fed's doing everything. He's perfectly analyzed the data. Nobody can analyze it better than him and his Fed gang crew. And they've laid out a perfect dot plot scenario, and they're the smartest people in the world. And as a result, inflation's going to come down, unemployment's not going to spike, and he's going to slowly add more cuts, causing the economy to slowly rise while inflation remains under control. That's the Goldilocks environment. And if that were to happen, the markets would actually rally. We'd go on another long 12-month 2025 bull move if we got cuts and good data. Cuts and good data. So what do I believe is going to happen? Personally, I don't think the data is that bad. I think the AI story is different than the dot-com story. And so I actually believe we're going to get cuts and some bad data. And I believe that we will have to pay the piper with at least a 20% downturn. I largely think that'll happen in 2025 when we get closer to the worst of the data. And I don't think we're at that point. I think the Q3 is going to turn out pretty good. Even Q4 could turn out pretty good. We're in that election year. The Fed's being responsive. The markets don't have a reason to panic, and neither do you. You got to do your own research. Neither do I. Now, let me cover some charts. Let me know if you guys found that interesting. If you did, hit the like for me. If you thought that was good overview on rate cuts, recession, and where we're at. And just let me know what you think. If you think we're going down 20%, or if this is one of the bad moments in history where we're going down 50%, let me know. I'd love to hear your opinion and how you're positioning yourself. And on that note, let's go into the charts and see how they're positioned. I'm going to go through some heat maps. I'm going to go through 3 stocks that I think you need to be keeping your eye on right now. Let's go check them out. Here's how the market ended today. Tesla got hit the hardest out of the Magnificent Seven. AVGO, not part of the Magnificent Seven, but darn, down 4%. And Nvidia not having a good day. Meta, somewhere in between Apple flat and Google flat, and Netflix is doing pretty good flat. All right, crypto. This is the day. So we've not having a good day, but we actually had a pretty darn good week. We're still green across the board. Bitcoin popped over the weekend, and we're in a good spot. I'm going to take you into the Bitcoin chart here in just a minute, but let's get our reality check on the SPY. Why do I call it a reality check? Well, let me go through a couple things. 555, this is structure support right back here. Guys, if you're trying to learn how to read charts, we've got rejection, rejection, support, support. 555 is our current area of resistance turned support. So this is our area we're going to be keeping our eye on. If that were to break, we have to come back to 544, and that's a gap that we would need to fill. It's also structure support back here. Charting is simple. Here's the main point of today's analysis of the SPY. 5-day EMA, exponential moving average that you see drawn on your chart. All these candles are still above it. These 3 red candles, still above it. The posture and the stance of the market is on offense. We're getting a little bit of consolidation because of this monumental 10% recovery move. It's reasonable that things are slowing down, but until this 5 EMA breaks, this is a hot uptrending market. All right, let's go look at Bitcoin. You guys can see right off the bat, I've got an inverted head and shoulders pattern. And the good news is that we're above the 60K level, and I've had that as a line in the sand for a long time. We're also postured in a bullish stance on Bitcoin. I'm going to do a deep dive with Tim on crypto tomorrow. We're going to do a live analysis of Bitcoin and other cryptocurrencies. We're 182 days, I believe, 182 days of consolidation. And one of the reasons why we analyze charts is that we know through past analysis that Bitcoin typically consolidates for around 200 days before breaking out. We're in an up move. This descending channel, even though it's a megaphone channel, is still bullish. They typically break to the upside. We're above a critical level of support here at 60K, which means that I have the view that we are more likely to move back to the top of the channel. And that's where I've got this path drawn. I think largely until we get through that 200 days, this can still move sideways. We've got a shoulder, a head, possibly another shoulder, another opportunity to go up to 70, come back and bounce again off 60, make a higher low, and then ultimately break out to 77K. Bitcoin and cryptocurrency love monetary easing. They might separate from the rest of the pack, and they may continue to climb all the way into the end of this year because of easing. What is largely cryptocurrency? It needs a lot of liquidity, guys. It's currency. It needs a lot of liquidity to pour into these assets for them to go higher. And we've been in a restrictive environment for quite a while. When we start getting those rate cuts, we could find that Bitcoin and the alts continue to rally all the way into the end of this year, even if the S&P 500 and the NASDAQ 100 begin to pull back as a response to the Fed cutting. So I'm bullish on crypto right now. Let's get back to the charts. All right, we've got to talk about Nvidia. Same situation, no reason to sell. Every one of these candles is on top of the 5 EMA. I told you when we got up here that we would eventually hit this 131 and that 124 was going to act as support. The last time we broke beneath 124, it bounced back to the top of the channel. Today, we came back and tested 124, and we got a nice, beautiful wick. All of that is bullish, right? You have to consider a stop loss somewhere underneath this 124, whatever you feel comfortable with to protect your capital if that's what you want to do. Right now, we're above the 5 EMA. We're bouncing off of support. We're moving towards Nvidia's earnings. And if we do break above 131, this is actually a very critical moment because we have got a triple top resistance. And if we get the price above, it's considered a true breakout, and price could easily push up to 146. Now, if we go into the momentum story, there's a lot of reasons to be bullish there. I've talked about this at previous times in covering Nvidia. We had an area of momentum resistance. Once we eventually broke above, we bounced along the top of our RSI moving average, pushing the price to all-time highs. We're in a very similar situation right now. We've had this area of momentum resistance. We've broken above it, and now we have our very first potential bounce on the RSI. This can continue to bounce until we get all the way back to momentum highs. You also have the stochastic RSI, tells a very similar story. The last time we crossed from the bottom to the top, we had this strong move up, and price action largely moved sideways, staying above the 5 EMA until we bounced on the top of the 80% channel, only giving us the next much stronger push higher. We've done the same thing here. We moved from the bottom to the top of the channel. We bounced on the 80. So again, I see Nvidia as setting up for a potential big move. So there's absolutely no guarantee of that. The story can change. Nvidia's earnings could be poor. They also could be a shock and awe earnings moment where they hit the ball out of the park again, like Babe Ruth pointing to the outfield. That's personally what I think could happen, but I'm going to have to take a hedge. I'm going to have to take a hedge before earnings, depending on what the chart gives me all the way up till Tuesday evening. I'm going to have to consider a hedge, and I'll let everybody know what that hedge is in the Stocks with Josh Discord. At the moment, I've been holding strong on my Nvidia because I've been confident in the charts and the story that the charts have been telling. And what is the story the charts are telling? Bullish trend. The trend is bullish. We're on offense. We're moving forward. Not every single candle is going to be green every day. It's not the way Wall Street works. But as long as those candles remain above that hot 5 EMA, well, then the trend is on fire still. And so I like Nvidia. I also am in a meta play. I'll go quickly into that chart and show you those details real quick. Now, this scenario is the white EMA is the 21 EMA. And the last time we had a big move up, we did have to come back and bounce on that 21 EMA a handful of times before making an all-time high. Ever since we broke above the 21 EMA, we have been moving higher. We've got this bullish descending channel. We've come back and had our first bounce off the 21 EMA, and we got a beautiful wick. The area that I think we need to be watching is this 521. As long as we stay above it, I think we're in a bullish stance. If we break above 533.50 and we close a candle up here, then I think we're confirmed for a move up to 564. When could that move be realized? Between now and if you follow the data I gave you at the beginning, all the way for a month after, potentially, we get that first rate cut from the Fed. And so it's a pretty big window where these markets can march higher, both on Nvidia, Bitcoin, Meta, and some of the other big tech plays. I'm in some Tesla options as well. I believe we're going to hit 232 there. And so these days are buying opportunities if you're willing to take on that risk. But I would encourage you to control your position size and be patient and let the markets pull back and come to you a little bit because you can get a better price. I've been getting better prices on my options today. Let me know what you guys are holding strong for the next 30 days or 45 days, or whether you're abandoning this market. Let me know in the comments. I'd love to hear your opinion. Hit that like and subscribe to get the next video. Don't sleep on the Chart Goat University Stocks with Josh Discord. Come join us over there. You can learn some charting from me, and you can trade alongside me and the Crown Traders. Check it out. Peace and blessings. Take care.